So first of all, to give a keynote speech, I'd like to introduce Dr. Richard Smith, who is the CEO and founder of Tradesmith.
Well, thank you very much for having me again, and for Scandinavian Capital Markets for sponsoring this. My background is in retail equities investing and helping retail investors be successful in the financial markets. And I came at it from a little different way than a lot of people. I actually started out as a retail investor myself. So it's 1999 or so, and the stock market's booming in the United States. I'm working on my PhD in a field called systems science. My undergrad was in mathematics, and I'm studying how scientists and researchers use uncertainty in their forecasting and in their research to do model building. And I start to invest in the stock market. It's 1999. I get my life savings together, $10,000, and by March of 2000, I'm up to $40,000, right? And I'm really patting myself on the back about what a brilliant investor I am. That PhD is really paying off, right? And I'm about to get married too. I'm getting married in June of 2000, and I'm telling the in-laws, hey, don't worry about it. I got the wedding expenses covered. Don't need any help, I'm a real man. And then March 2000 rolls around, right? And the rug gets pulled out from under me, and from $40,000, my account is like overnight at $35,000. What the heck just happened? Well, okay, I'm sure it'll come back, But instead of coming back now, it's $30,000, and then it's $25,000, right? And then I say, well, okay, if it could just get back to $30,000, then I'll get out. And it gets back to $30,000. And I say, well, maybe I won't get out, It could go back to $40,000. I mean, why couldn't it go to $50,000? Now remember, I'm a mathematician. I'm a PhD. I'm working on, I'm a doctor of uncertainty, right? And I'm acting like a total blathering idiot in the stock market. So that was like a wake-up call to me. I finally got out with my original $10,000 intact, okay? So my 300% paper profits were gone nearly overnight in a very short period of time. Much shorter period of time than it had taken me to build up those 300% profits. And then I realized that, hey, I'm not the only one who's having this experience of really not knowing how to manage risk in the markets, right? And I had some pretty big advantages over most of the people who were trying to do this successfully. So that was disorienting, but being a persistent guy, I said, well, I'm not going to give up. I'm going to figure out how the heck this works. And I met some colleagues along the way, and in 2005, I launched a service called TradeStops. And TradeStops helped individual investors track trailing stop losses in the markets, okay? Nothing radical, but some publishers that I had met were writing newsletters that I was reading, and they said, hey, my readers are always writing to me asking me how to track trailing stops, and I never have a good answer for them. And so I said, well, why don't I build something? And then you could tell them about it. And they were like, sure, great. So I built this service called TradeStops in 2005, got my first customer in 2005, literally like almost 15 years ago now. And we started out offering simple trailing stop alerts, right? And everybody knows what trailing stops are, especially today. And what I figured out over time was that, and I think this is very illustrative of what I want you to really understand about retail investors and what I've come to understand. We don't just need indicators, right? We really need indicators coupled with a narrative about why to use those indicators, right? We need to understand, we need to believe in the systems that we're using, because there's really an infinite number of systems available to retail investors out there, right? And everybody's throwing more and more information at us as retail investors. But we don't need more information. We need ways to make systematic decisions that we understand in order to be successful over the long run. So what I was able to do with trailing stops is connect them to behavioral finance. So I tell my subscribers, and by the way, I have over 30,000 subscribers now in TradeStops that track over $20 billion of assets on my platform for retail investors in the United States. Excuse me just one moment. So Trailing stops help retail investors because as retail investors and as human beings, we hate to lose. And there have been 2 Nobel Prizes in economics now awarded for this observation that we hate to lose. Daniel Kahneman, right, of Kahneman and Tversky. Daniel Kahneman wrote Thinking Fast and Slow recently. Of course, he did a lot more besides that, but he got the Nobel Prize in about 2002, I think, for pointing out that we hate to lose. We have loss aversion. And then Richard Thaler, who was the student of Daniel Kahneman, in I think 2017, got the Nobel Prize for pointing out not only do we hate to lose, but we always want to get back to break even. Okay? So we hate to lose, and as human beings and as decision makers in the financial markets, our loss aversion manifests in different ways when it comes to our losses and our gains. When we are losing on an investment and we hate to lose, we don't want to take the loss, right? So we hold on to the position, we double down on the position, we are risk seeking when we're losing. We want to take on more risk to try to get back to break even, okay? But when we're winning, our loss aversion manifests as wanting to take our profits off the table, right? We're afraid of losing our profits. And this is just what I observed in my own experience as an investor. How come, occasionally I have 80, 90, 95% losses, but I don't have the corresponding, 500, 900, 1,000% gains, right? Because to get back from a 90% loss, you have to have 1,000% gain. But many people experience 90% losses, not many people experience 1,000% gains, right? And then later on I was able to see, oh, okay, that's exactly what's happening to me over and over again. And that's what's happening to retail investors over and over again. We're doubling down on our losers. We're trying to dig out, get back to break even, right? And then when it comes to our winners, we're taking them off the table early, right? So that was the prospect theory from Kahneman and Tversky, right? You get 100% gain and you're like, yeah, I got what I came here for. Let me get out of here, right? But you get a 50, 60, 70% loss. You want to double down, try to get back to break even, et cetera. So giving people that narrative of why trailing stops actually help them reverse this bias that we all have, right? Trailing stops help you limit your losses, and they also help you to unlimit your gains. So my point in going through this whole topic is to help you understand that people need a narrative about why a system makes sense for them, and not just more indicators and more information. So I started in the space of financial newsletters, and basically I've been trying to solve the problem of hundreds of thousands of retail investors who have lots of good investment ideas, but no idea how to manage a portfolio and manage risk in their portfolio. So I started out with trailing stops. I connected it to behavioral finance. And there's so much knowledge and information and insights in behavioral finance. Alberto and I have been having great conversations about that today. And what I believe is that through technology and through design and through relationships and education, we can really create entirely new opportunities for retail investors. And retail investors are not as dumb as everybody thinks they are, right? And I tell you, we're figuring it out quick. With social media, right? There's just not as much tolerance. People are getting connected, they're getting educated, they're finding out what their options are, and the people and the service providers who can really connect with genuine retail investors who are serious about succeeding in the markets. They're not just there for a little Las Vegas style entertainment, right? Which a lot of people, maybe that's why they get involved in the markets, but ultimately we got to walk them up a higher ladder of value. We have to take them on an experience, and maybe initially we won't make as much money because, right out of the gate, they're not like churning their accounts and blowing themselves up in a 3-month period, right? But if we can, keep them around for a year, get them involved, help them make a little money, be successful, feed their need to, be doing something, because then one of the big behavioral biases we all have is feeling like we need to do something, right? Over trading is the biggest source of underperformance of the retail investor. So how do we take people on this journey of getting educated, getting engaged, and not only being with us for 3 to 6 months, but being with us for 3 to 6 years, or even better, 3 to 6 decades, or 3 to 6 generations. So at this point in my work, I've built a great risk management platform for retail investors that started with trailing stops, but then I developed what I call the volatility quotient. I was trying to find the optimal trailing stop to use if you want to hold the stock for 12 to 18 months minimum, okay? So how much noise or uncertainty do you need to put up with if you want to hold the stock for 12 to 18 months? It might be 12% on Walmart and Johnson & Johnson, and 18% on Apple and Microsoft, and 30% on Tedder and Twistler. Tesla and Twitter. And I was trying to solve the problem of what's the optimal stop loss to use, right? But I saw that, oh my God, people just saw that number and they're like, wait a minute, 12% on Walmart and 30% on Tesla? Oh, okay, those are different stocks. Look, retail investors are not stupid people, but this is new information for them, right? Because they don't understand Sharpe ratios or Sortinos, or they're not financial professionals. They're entrepreneurs, they're doctors, they're dentists, they're lawyers, and they don't have time to go through all this. So I gave them a simple way to understand volatility and uncertainty. And hey, if you want to hold this stock for 12 to 18 months, this is how much noise you need to be okay with, right? And then to be able to decide when to sell, when to buy, and how much to invest based on that volatility quotient number. And now I've got a system where they can have inputs of ideas that they get from their newsletters or from 13F data from billionaire investors, and use momentum and use volatility and build a portfolio of equities with minimal correlation between those equities, and basically have hedge fund level analytics in an easy to use, easy to understand platform where they can make decisions, build portfolios that are unique to them, not just be doing the same thing as everybody else. Because I think one of the beautiful things about our capital markets is that it gives individuals a way to uniquely express themselves in the capital markets, right? And I'm kind of against the move to ETFs and everybody essentially following the herd and doing the same things. I don't think that's going to work out for our capital markets long term very well. I'm personally concerned about it, and I also think that it's really damaging the diversity of our capital markets. So really giving retail investors a pathway into the markets where they're not going to blow themselves up right out of the gate. They're going to be able to get educated, come along for the journey, be more valuable customers to us long term, and ultimately help to restore some diversity and some sanity to the capital markets. So there's a quote from Warren Buffett that I often share with my subscribers and prospects that goes something to the effect of, if I only had to manage $1 million in the market, I'm sure I could do 50% a year. And I say to my subscribers, look, we're not Warren Buffett, we're not going to necessarily do 50% a year, but we have unique advantages over institutional and large investors in the markets of being very nimble, of being very agile, of not having to answer to boards of directors and investors who were managing their money, right? So I think there's incredible opportunities for the retail investor. I think the retail investor is really waking up and becoming more aware of the fact that they really want to be successful and that they're not in this just for a game. And I think there's an incredible opportunity to educate the public, to bring new life into the financial markets and new prospects, because most people out there want to be involved in the financial markets, but they are rightfully wary, because either they've touched the stove and gotten burned and don't want to do that again, right? Or they've, somebody they know has done that. And Wall Street has done a great job of making us all feel intimidated and a little bit ashamed, and feeling like we can't do this ourselves. But that's just not true. So That's been what I've been doing for the past 15 years, and I've seen a tremendous response from people who really do want to succeed in the capital markets, are willing to do a little bit of work to make that happen, are willing to look at themselves and acknowledge that maybe they didn't go about it the best way from the beginning, but we have to help them do that. We have to help them see that. And that's something that I've been inspired with Finance Feeds and Scandinavian Capital Markets. These guys really care about the retail investor, and that's why they invited me here. And that's what they're doing in the market. So kudos to you. Thank you, Andrew.
Very wise words indeed from Dr. Richard Smith. And actually now we'd like to move on to the panel.